Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the low time frame bullish scenario where we're looking at a finished triangle ABCDE where the low is in and we're now looking for an impulse towards the upside. In this scenario, wave E is a double zigzag structure in a WXY, which is rare for a wave E because most commonly a double zigzag would appear in a C and a wave D. If wave E in a triangle is any sort of a complex structure, then most commonly it becomes a triangle itself and not a double zigzag. So the fact we have a double zigzag in here does lower the probabilities of this scenario, this being the low of E, and now an impulse to the upside for new highs, as this triangle would then be the end of a wave 4, and we're looking for a higher time frame wave 5 to the upside. If price moves to the upside over here and takes this high, this scenario becomes very likely indeed. However, if price would move to the downside, move below this low over here, this scenario would be invalidated. If we then zoom into the lower time frame in confluence with that scenario, where then the low is in of wave E and we are looking for an impulse to the upside, we want to see here, this being a wave 1, preferably price retracing just a little bit more for a wave 2 before then continuation to the upside in a wave 3. The reason I mentioned that for a wave 2 preferably you see price retracing a little bit more is because the common wave 2 targets are between the 0.5 and the 786 Fibonacci, which is between 36.2k and 35.9k. The 0.382 is a less common target for a wave 2. If we then do look for price to move to the upside, we want usually at least the 1.618 to be hit for a wave 3, which is sitting at 38.1k, but generally the moment you're going to take this double top, an impulse to the upside would be confirmed. If we then zoom out and look at the more bearish scenario, or in other words actually more ranging scenario, we are looking at a WXY with inside wave Y the triangle that is not yet finished. So we are then looking for a zigzag in a wave D and then a wave E to the downside, which then also is a zigzag before then continuation to the upside. In this scenario, wave C is the double zigzag, which is a common pattern in a wave C or a wave D, but in this case it is a wave C, and 4 out of the 5 waves have to be a simple zigzag structure in a triangle. Meaning, because wave C is a complex structure, all the other structures have to be simple zigzag structures in a 5-3-5 up ABC or a 5-3-5 down in an ABC. We're looking for resistance for this wave D, where this resistance over here is the most important one. The upper blue box sitting between 37.4k and 37.6k. We do have a little bit of resistance in between here, 36.9k to 37.1k. If we then zoom in to the micro, which is in confluence with this more bearish scenario, we're looking for a 3-wave structure to the upside. So now this becomes a wave A, 5-wave move to the upside. Wave B is potentially already in, and then you're going to be looking for a wave C to the upside. Now, if this is the low of B, then the most common target area for C is right on top of this blue box, right? It's now sitting between 37.4k and 37.6k. For a wave B, the common Fibonacci retracement targets taken from the low to the high of A are all of these, the 382 to the 886. And that is the reason why if price bounces on the 382, it's usually a little more common for a wave B, less common for a wave 2, meaning probabilities generally are a little bit higher that the move then to the upside becomes a wave C instead of a 2. However, again, for the bullish scenario, you can have wave 2 bouncing on the 382. It then really depends on the move that you get to the upside. You want to see 5 waves in a wave C to the upside before you reach this box. If it is just going to be a straight line to the upside without any wave 4 retracement in the meantime, probabilities of course increase for continuation, but we have to wait and see how price then moves towards the upside. If we do look at this range, and in case price comes down once more, we do have some additional support down here. We have the bigger support resistance area, which is this white box over here, just below this low. You also have the value area low of the range here at 36.1718k. And also you have the golden pocket. If you take a Fibonacci then from the low to the high here, right? Then you also have the golden pocket and the 0.5 common targets for both a wave B as well as for a wave 2. Looking towards the upside, you can see that the value area high of this range is one of the confluences in this area as resistance, as well as a daily also in that area. Now, if we look at the CVD divergences, we do have a bullish CVD divergences here with this pivot low and this pivot low, higher low in price, lower low on the CVD. Preferably, price makes bullish CVD divergences with the actual low over here, right? But at the moment, price did not retrace deep enough for that to happen. If we look at the 15-minute chart and we have a look over here, then you can see we have the low, the red candle here, which gave us this yellow line and this blue line here, right? If we look to the right side, then you can see that the yellow line here is below my horizontal cursor line, right? So it's a lower low on CVD, but a higher low on price, which is a bullish CVD divergence, both on yellow as well as on blue. However, this green candle is the actual low, which means the yellow line still needs to drop a little bit further to around here. And also the blue line did not drop far enough to have bullish CVD divergences with the actual low. However, it is a bullish divergence nonetheless. We have to keep it in mind where the target is taking this high over here. The moment this high is taken, the bullish CVD divergence has played out. And if you do take a Fibonacci from this low to this high, and you just focus on the golden pocket, then what you will see is that price very nicely bounced on top of the golden pocket over here. So that adds a little bit of confluence to this bullish CVD divergence. If we then look at the probabilities of the different scenarios, then on the low time frame I wrote neutral, meaning between the bullish scenario, wave E already finished, looking for a continuation, or the bearish scenario where we're looking for a D and then an E to the downside, is kind of like almost like 50-50, but preferably actually when looking at this structure to the downside, the probabilities would be higher for a D and then an E before then continuation to the upside, because a double zigzag is rare in a wave E, right? This structure in a WXY is actually not what you want to see in a wave E, which increases the probabilities for this scenario. So actually I should have written down that this scenario over here has a higher probability with a rejection over here and a move to the downside. Of course, we have to observe the reaction, right? We're in a bull market in general over the past couple of weeks, if not months, right? So make sure you have proof of resistance and have entry requirements. And if we look at the micro scenario, then currently the highest probability scenario is simply upside, either in an ABC or a 1, 2, 3 for continuation. It really depends on how price will move to the upside, where this target box specifically is going to play an important role, because this is also a wave C target in a potential ABC. If we manage to get through this and make a new high, then we can look for price to move to the upside, where we first of all take the double top, observe the reaction there at 38K, and then we have 38.5 to 39K. I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.